We're now joined by Shaun Roache, who's the Chief Economist of the Asia Pacific region. Thanks for joining in, Shaun.
Thanks for having me.
Great to have you with us. So, let's begin the conversations today with the Asia markets. Everyone's talking about the US markets and the impact on the Dow and the S&P. But we also want to touch base with you a little bit about what's happening in the Asia Pacific region. How are things looking to you also for Indian equities?
Yeah, right now I don't think markets are convinced that the Fed's rate cut that we saw yesterday is going to be enough to put a floor under the level of risk that we're seeing at the moment, and we're still seeing some weakness in regional equities. I think reflecting the fact that many people don't see monetary policy as the answer to this problem.
If you look at the way the markets reacted yesterday post the Fed's big cut, there's barely been any relief, So what are we looking at here? Are we looking at cues to come in over this next 6 to 9 months that are going to tell us more about how to respond? Are we going to see a broad-based sell-off due to panic? What should investors really brace themselves for going forward?
Well, at the moment, our baseline assumption is that the virus will be contained sometime in the second quarter, that is before June. Now, that's based on specialist medical opinion, of course. And if that were to be true, we think we would see the global economy enter a U-shaped recovery that would really start to kick in the third quarter and pick up pace in the fourth quarter. So we don't see a disastrous scenario at this point. Of course, the conditions remain highly uncertain, but if that's the case, then there is a fairly strong conviction that we have that much of the lost growth that we've seen in the first half of this year can be regained next year.
Shaun, good morning. This is Cheryl also joining on the other side. Let's talk about your report that you released last night about the U.S. growth forecast, where you have gone ahead and cut the U.S. growth forecast for the second time. Do you foresee similar cuts in the growth forecast coming in for Asia, particularly India?
I think now we're getting to the point where the downgrades may come a little bit quicker. For a couple of different reasons. First of all, this is now becoming more of a global shock than just a U.S. shock. So much of the downgrade to the U.S. reflects that, of course, the virus is spreading there, and the same supply and demand shocks that we've seen play out in China could start to affect the U.S. That's also true of Europe. So this is now a very broad-based shock. That will clearly have an impact on India through the trade channel, and so we'll see a weaker external demand in India. We could, over time as well, as the number of reported cases globally goes up, and perhaps in India too, see a hit to household and business confidence, which we know has already taken a knock in India. And then that could also further drag on growth as we go through this year. So for now, we do see the risks to our forecasts for Asia Pacific and India as still on the downside.
And do you see other central banks following suit to what the US did last night? Do you expect any similar reactions here from the local central banks?
Yes, we've already started to see some central banks in Asia Pacific cut rates. We saw Australia yesterday, of course, and also Malaysia. Earlier on this year, we've seen both Indonesia and the Philippines cut rates. And we should expect to see more monetary easing, because it is at least one way that policymakers can cushion the blow. But I think what's key in Asia, and which distinguishes the region from what we're seeing in the US and Europe, is very active fiscal policies, and this is helping. So in many economies like Hong Kong, Singapore, Korea, we're seeing budgets being eased, we're seeing spending being directed to affected sectors, transfers to households, and that's going to help some affected firms live through the shock and allow them to at least live with a little bit more cash flow than they otherwise would have done. That can protect jobs. And then as we go through later this year and the recovery comes through, those firms will be in a much better position. So I think in our region, we're going to see a little bit more fiscal rather than monetary policy.
Let's talk more about coronavirus, Shaun. What's the impact of coronavirus? Do you see any secondary impact on that front because of the virus?
Yes, we think there are a number of different ways this has an effect. I mean, people are talking a lot about supply chains, and that is, of course, important. We're seeing some disruptions in China in the autos and electronics sector. That's getting worse because we're seeing some effects also in Korea now, where the virus is spreading, and that's also affecting those same sectors. Shipping and logistics is also being affected, so getting goods in and out of China, which is the hub of regional trade, that's become a bit of a problem. So there is this supply chain problem. But there is also a demand side, which is where you have households in a larger number of economies now that really want to avoid going out in public because they feel that the risk of infection is high. And if they're not in public, they're not spending on consumer discretionary goods and services. So it could be eating out at restaurants, going to movie theaters, and it also, of course, means travel and tourism. So those two shocks, both on the supply and the demand side, are the most important ones driving growth lower at the moment.
So I have just two follow-up questions for you. You know, firstly, we spoke to a few economists this morning, and what many of them thought was that the 50 bips cut was a bit exaggerated and that it came in, you know, in an untimely fashion. That's what actually caused more of a panic than it did actually alleviate any concerns. So, you know, also while lowering rates does encourage economic activity, what's it going to do to, you know, sustainability of economic expansion as well as reducing purchasing power? What about that impact? And then the second question I have for you is, where are the commodities, gold, and, you know, other safe havens heading in the interim next couple quarters?
Yeah, so on first of all, monetary policy, I think I would agree with a lot of people that are saying, look, this isn't that effective in the short run because simply lowering interest rates isn't going to make firms invest or households go out and spend because this is a different type of shock. The other problem with monetary policy is that it tends to act with a lag. So it might actually start kicking in later this year when growth is recovering anyway. But I think at the moment, central banks in some economies are being forced to take action because the governments are not moving quick enough on fiscal policy. Again, that's not so much of a problem in our region where we're seeing fiscal policymakers move on taxes and transfers. But in other economies, and I think the U.S. is a prime example, the central bank really is carrying all the load, and I don't think that's very healthy. In terms of commodity prices, I think we should split it up into things like precious metals, which some people see as a hedge against uncertainty, and other heavier commodities, which are more exposed, I think, to China. In terms of precious metals, that really will depend, I think, on the level of uncertainty in financial markets. If we start to see some evidence that the virus is being contained and risk falls, we could see some of those precious metals prices fall as people move out of hedges and back into risk assets. In terms of the heavy commodities, I think this is really going to depend on what happens in China and specifically China's housing market. China's housing market has taken a big knock so far this year, but for now, markets think it's coming back later this year, and the impact on commodities like coal and iron ore has been limited. But if we see evidence of permanent damage to China's property market, we could see some further downside to those commodity prices later this year.
Just a quick note, just a quick question on how the global companies are trying to contain the spread of coronavirus in their workplaces. Has S&P also moved to virtual meetings like most of them, but they've gone ahead, they've cut their teleconferences as well?
I think, yeah, most businesses, certainly I think Singapore is an interesting case study where, you know, where I see across the industry there is a number of different methods that people are using at the moment. One common method here in Singapore is that teams are split into two, and so 50% of the team work from home and 50% of the team work in the office, and then they split every week. So that does two things. It prevents the entire team getting infected, and also it increases the distance between workers in the office. And of course, there's lots of liberal use of work from home policies, which, you know, based on some of my conversations around Singapore, seem to be working pretty well. And for now, working from home seems to be a viable solution for most firms, at least in the service sector.
Thank you for joining us and giving us your take on the entire global economy.